Ever since the euro was created, it's been haunted by this deep, persistent economic puzzle, these risky imbalances that honestly threaten the entire project. So to get to the bottom of this, we're going to play detective and follow the clues uncovered by researchers Carrasco and Tovar-Garcia, who think they finally found what's really driving this divide.
Just think about it. On one side, you have these economic powerhouses just chugging along, and on the other, you've got nations that have really struggled with these persistent deficits. The weird thing is, the standard economic answers, they don't quite explain it. So what is this hidden force creating such a massive gap?
Okay, to solve this mystery, we first need to understand the scene of the crime. So let's take a look at the promise of the euro versus the reality that actually unfolded.
In the original vision, it was beautiful, really, simple and powerful. The idea was, hey, let's create a single currency. That way you get rid of all that messy exchange rate risk, you boost trade, and, this is the big one, all of Europe's economies would start to converge, leading to shared prosperity for everyone. A truly unified market. That was the dream.
But, well, that's not what happened at all. And this chart really tells the story. It's pretty stark. Almost immediately after the euro was adopted, this huge split started to happen. You had nations like Germany and the Netherlands racking up these massive trade surpluses, while countries like Greece, Spain, and Portugal, they fell into deep, persistent deficits. Instead of coming together, they were pulling apart.
So, what on earth caused this?
Well, any economic detective would tell you the first step is to round up the usual suspects that explain trade imbalances.
And just so we're all on the same page, the core concept here is the trade balance. A surplus simply means you're selling more stuff to the world than you're buying. A deficit means the opposite. Pretty straightforward, right?
Now, the two main culprits economists usually point to are relative prices, how cheap your products are compared to others, and relative national income, which is all about how fast your economy is growing and sucking in imports. These are the textbook answers.
But here's the twist in our story. When researchers applied these standard models to the Eurozone data, the numbers just didn't make sense. The usual suspects, they didn't seem to be responsible for what was going on.
And this isn't just a hunch. The researchers stated directly, the data showed no real link between these traditional factors and the trade balances. This meant the real cause had to be something deeper, something structural that the standard models were completely missing.
So, with the usual suspects rolled out, the investigation had to turn to a totally new type of evidence. It wasn't about how much countries were trading, but what they were trading.
Okay, and this is a really crucial point. Economies can basically compete in two fundamental ways. You can compete on price, which is just trying to be the cheapest, or you can compete on what's called non-price factors. This is about being better, more innovative, higher quality, more advanced. It's a completely different game.
And boom, this is the breakthrough. The data revealed this incredibly clear, robust, and powerful connection. The greater a country's share of high-technology exports, the stronger its trade balance. This wasn't some minor factor. This was the central clue that explained the entire mystery.
So how does this one clue solve the entire case? Let's put it all together, because this high-tech insight is the key that unlocks the whole puzzle of the Eurozone's divide.
This is the core finding, plain and simple. For the Eurozone countries, their economic destiny wasn't determined by price tags, but by the very nature of the goods they were sending out into the world.
So what makes these exports so powerful? Well, first they have high value added. Think of it this way. It's the difference between selling a block of raw wood and selling a beautifully handcrafted guitar. The value and the profit is much, much higher. Second, demand for these goods is inelastic. This is crucial. It means customers need these specialized products, like life-saving medical tech or critical software, and they'll buy them even if prices go up because there are no easy substitutes. And finally, this all creates a powerful positive feedback loop. It signals to the world that you've got a modern, frontier economy which attracts investment, and it requires and develops a highly skilled workforce, that human capital, that drives future innovation. And if you want to see this in action, just look at this staggering comparison. During that period of growing imbalances, a whopping 85% of Germany's manufactured exports were high-value goods. For Greece, that number was just under 54%. This isn't a small difference. It's a fundamental, structural gap that explains the divergent paths these economies took.
Okay, so understanding the problem is one thing, but what does this mean for the future? The study's findings point towards a completely new path for trying to fix the Eurozone's imbalances.
The takeaway here is that superficial, short-term adjustments just aren't going to cut it. The
The solution has to be structural. We're talking about a long-term shift towards industrial policies that actively encourage and build these high-value industries, supported by massive investment in education and skills, the human capital that you need for a modern, high-tech economy.
And this leaves us with the ultimate question. Re-engineering an entire economy's productive structure, well, that's a monumental task. Is it really possible for these nations to make that leap, or is this high-tech divide now a core, permanent feature of the Eurozone? The answer, whatever it is going to define the future of Europe.